Okay, Q&A time from the last market outlook. Studying for L2 November right now. Curious about how often you use models like binomial option pricing. Binomial option pricing. I got an N in there too many times. And BSM in the equity section. Figuring out when and where you would use comparables or build intrinsic value models felt a lot more intuitive to me, but I'm clueless about how practical the derivative models are and when to use them. So the BSM model is useful in knowing how the option price moves, not necessarily for calculating the fair value of an option, but for understanding how the option price moves when one of the variables move holding the others constant. That's a useful part there. The binomial option pricing model you'd probably never use unless you were buying an option on real property. So let's say that you wanted to buy an option on a piece of land because you wanted to, first of all, assess whether or not you could build a certain type of facility on it. And if you could, that land is worth a hell of a lot, but if you can't, the land's worth nothing. It would be like buying 25 acres of farmland without knowing whether or not you can build homes on it. If you can, the land is worth a lot. If you can't, it's worth nothing. And you can assess the value of each of those. And then you can use binomial option pricing for that, because it's a one-period model with known outcomes. You can price out what a fair value of an option would be. But for continuous pricing, BSM, it's more important just to know how a change in one of the variables would affect the value of the option. That's really about it. Searching for a swap instrument as protection against inflation over the following 5 years. Okay, well, there's interest rate swaps. The idea would be to pay the 5-year TIPS break-even rate, pay the 5-year real rate, and receive in exchange whatever the official CPI is. Why would you do that? What if CPI goes to 1.2%? Right? I guess you're willing to do that because you're making the bet that CPI will be higher than the real rate of 2.3. I don't know about that. I don't think that the swaps are done based on a real rate. Your swap will be, if you're swapping inflation for fixed, it'll be a fixed rate, not based on tips, and it'll most likely be a floating rate, at least. I've never used interest rate swaps, so I can't really speak to them. They're OTC. I don't know whether or not you'd be a good counterparty for OTC. You don't want to lock the principal for 5 years, which means you want to swap. I just don't know if you can get it done. So if you can do OTC, call your dealer and tell them what you want, or her what you want, and see what happens. Simple question, what is your outlook for the stock market over the next year? I have no clue. I would say heightened uncertainty. Pick a time, pick the most uncertain that you could be about something. In other words, uncertainty is 50-50. Flip a coin. That's where I am. Flip a coin. I have no idea. Research process metrics to Susan, looking at REITs such as Annaly and Arbor. I did a 2-part series on Arbor. It should be on this channel. Just search for ABR. You should be able to find it on this channel. It's 2 parts. How would you invest in the U.S. if your dividends were taxed at 30%? I'd try to avoid dividends. I would, if I can't, I would use synthetics. In other words, I would use options to get it done, and I would use leaps, 1-year options, but there is a cost of carry to getting that done. Or I would just simply probably, I'm curious. If you bought a mutual fund, and I haven't really asked anybody this because I'm not a tax expert, but if you bought a mutual fund, because the mutual fund doesn't distribute its earnings, it just simply gives you more units, you're still getting the tax receipt to claim the type of income you received, but because you're not actually receiving the distribution, it might be a gray area. There might be a possibility of avoiding the withholding there. I would really want to build a 60-40 small portfolio through ETFs, but the dividend tax takes a chunk of your returns. Yeah, maybe try mutual funds. More general question, given the average yearly return for the stock market seems to exceed that of real estate in the last 20 years, on average, would it be reasonable to conclude that the stock market is simply a better investment than real estate? Where are you seeing that? Average yearly return seems to exceed that of real estate. I don't think so. From 2010 to 2020, REITs outperformed the S&P. So I don't know where you're getting that. You can't take real estate as a whole. Real estate is the same as saying, well, what are you invested in? Well, I'm invested in technology. Well, what do you mean technology, right? I mean, that's a big word to say I'm invested in technology. You have residential REITs, office REITs, retail REITs, industrial REITs, timber REITs, storage REITs. I mean, there's a whole bunch. Medical buildings. I'm not sure what you mean by real estate, and I'm not sure what you're looking at to come to that conclusion. If I had 150 and had to choose, in the long run, I would be better off putting it in the S&P than buying a property and renting out. In the long run, you'd be better off putting it in NASDAQ rather than S&P, and probably a mix of NASDAQ and energy instead of S&P. S&P is not the best performer out there over the long run. It's a good performer with moderate volatility. The triple Qs have a better track record of performance than S&P does, with higher volatility. You got to live with that, but you can do better just going into the NASDAQ as opposed to the S&P. Buying a property and renting it out. Well, no, I don't think you can do better than buying a property and renting it out. You have to understand the concept of leverage and the concept of carry. Right now, with interest rates where they are, with mortgage rates where they are, yeah, you could probably do better somewhere else than in real estate. But when mortgage rates were 3%, and loan to value ratios, if you're buying a house and it's not a commercial property but a residential property, you could buy it with 10% down, so you got 90% leverage, or 10% equity, 90% debt in there at 3%. So if you can get a cap rate on your property of about 5%, which up to about 2015, 2016, you could 5.5 to 5%. Then it dropped below 5, got as low as 4.5%. You have the carry in between here, between the 3 and the 5%, with a very low amount of equity. So you're allowing not only that, if it's in the U.S., you have a tax deductible. Not actually anywhere, because this is now a rental property, so you have tax deductibility of the interest. So if you're like me with a 53% tax rate, this 3% is really less than 1.5% financing cost at a 5% cap rate, and you have a huge depreciation shield in your first 5 years, so that you're basically paying no tax for the first 5 years, and you're paying down your debt. And if you have a market where property prices are going up, your return on equity, S&P can't touch that. The S&P cannot touch that. What you're missing here is the leverage that you can get. S&P, 2 times leverage. Right, in housing, 9 times leverage. It's this and the carry, that you're getting in here. You know what your carry is. You have positive carry. So no, you cannot. You cannot. Your biggest risk is who you rent to. That is your biggest risk. And if you only have one property, you have huge credit risk and you have huge concentration risk because you got one tenant. You're relying on one tenant, so you better pick well. But no, this is not a true statement. If selling for a tax loss isn't an option, how would you handle a still underwater TLT position? Why is selling for a tax loss not an option? Would you opt to wait and have faith that the position will eventually rebound? I don't need faith, I just need math. Math says the position will eventually rebound. Actually, for TLT, that's not true. Let me back that up. Math doesn't say it'll rebound because it tries to keep a constant duration. So it will sell at a loss. So it could lose some. Some capital. I don't understand why selling for a tax loss isn't an option. It's always an option. I don't understand why it's not an option. But what you can do is you can sell the TLT, take a tax loss, and simply just buy a U.S. Treasury with the same duration. Duration of about 17.6, which would be about a 25-year coupon paying bond, and try to find a low coupon. Right, a low coupon will have a higher duration. In fact, if you look at the 25-year strip, STRIP, it's 2028 now. That's 28%, so you'll pay $280, and it matures at $1,000. And if the long bond, if the 25-year goes back to 3%, this will go up 2.6 times. So you will more than double, and somewhere in the next 2 years, I do expect that we're going to have something's going to break. You can't keep going at these high rates. You simply can't stay at these high rates. There will be something that drops this, and it will drop. So TLT won't increase 2.6 times from where it is, but moving into the 25-year strip, you can actually. You'd only have to find a 17 or 18-year strip because you want to match the 17 to 18 duration. So find a 17 or 18-year strip. I don't know if that would be 2.6, but I did the math on the 25-year that if it were priced at a 3% coupon, what would it be? And based on where 280 is, it would be 2.6 times higher than that. So I don't know why a tax loss is not an option. It must be because you cannot sell. And if you cannot sell, well then why are you asking me the question of what to do? If you're saying, would you wait? If you can't sell, well then you have no choice but to wait. If you're asking me if you can wait, then you can sell, which means tax loss is an option, right? So I don't understand the question, I guess. With T-bonds and agency MBS seem to be good buys at the moment. In order to determine which of these two markets is more optimal buy, I've done some back-of-the-napkin math for most popular ETFs in the market. Taking into account coupon plus duration plus spreads, assuming a hypothetical drop of 100 basis points on the 10-year over the course of the next 12 months, my calculations always show that sovereign bonds have more upside than agency MBS. My specific question is if we believe that both T-bonds and agency MBS are to buy at these levels. What is the argument for picking MBS over treasuries at all? Well, you must be making the assumption that the spread on the MBS over the 10-year increases as the yield on the 10-year drops. Because if it didn't, holding the spread constant, if the yield on the 10-year dropped, the yield on the mortgage-backed security would drop by the same amount. And being that you'd have roughly about the same duration. Yeah, roughly about the same duration. You should do just as well. The only time you would do different is if the ETF had a lower duration than the 10-year. But if you're making the assumption that what causes the 10-year yield to drop would cause the spread to widen, then yeah, you'll do better just making an interest rate bet. But keep in mind, you have to combine that with your investment horizon. If your investment horizon is 20 years, if you're going to say, well, I'm going to buy something, I'm just going to put it away for 20 years, what do you care? What do you care what happens? Get the biggest yield. But if your investment horizon is a year, 6 months to a year, well, then, yeah, you've got to not only, you have the math, the bond math that says these will mature at par, period. They will mature at par. You're going to get that yield if you hold it to maturity. You're going to get the yield, period. That's math. That's not speculation, that's math. Speculation is time. If you have to sell the bond before its maturity date, well then, what causes rates to drop and in what time period will that happen? That's hard to do. I don't know which one I would take in that case. Probably the Treasury. Volatility home builders have Canadian much smaller cap stock than DHI, and Lennar also has some insider sales close to the peak share price this year and reported last week. So there's been a lot of answers for Hovnanian small cap, really small float, I should say, not small cap, small float. And the Hovnanian family have a controlling interest, which makes it difficult to get anything done unless they want to get something done. And because it has such a low share count, it doesn't have options. It wouldn't have options because of its low share count, and it's the low float that makes it really volatile. I'm considering moving from France to Australia. I'd like to determine what a reasonable target salary would be in Australian dollars, taking into consideration the overall cost of living there. With computing real exchange rate, you probably need to get a feel for what the equivalent of a decent salary in France would be in Australia. Well, you could. You could also just look at, the market is the market. If you say you're moving to a particular market, what's a good salary? The salary is what the market will bear. You could say, well, I need $300,000 if I move to that city, but there could be no possible way you're ever going to make $300,000 in that city. It may not translate the way you would like it to, but the easiest way to do it is have a look at what the median incomes are in France and what the median incomes are in Australia in relation to what GDP is. And you can resize the median income for what it would be in Australia. So let's say that in France the median income is 50,000 euro, and you earn 100,000 euro where you are now. There's the median income. You earn 100, so it's 2 times the median income. Well, there's your exchange rate on median income. Look at the median income in Australia, and if it's 75,000 AUD, then you'd be looking for 150, right? That's a more reasonable way to determine in a relative way what your position should be worth based on what the median income would be. In today's environment, if you wanted to invest in U.S. Treasuries and anticipate having to make a large purchase with those funds in 1 or 2 years, would you buy T-bills or buy longer-term bonds? Nope. Your investment horizon, what you're saying is 1 or 2 years, you're going to be in cash. You're going to be in 6-month Treasuries. Well, you could buy a 1 year if it says in 1 to 2 years. You could buy a 1 year. You can even buy a 2 year. It's going to have low duration and be liquid. So what I mean by low duration is as every day goes by, that bond becomes less and less and less sensitive to interest rates. In a year, it'll be a 1 year bond. You still have a coupon on it, but it'll be a 1 year bond. If you need the money in 1 to 2 years, but you don't know exactly when, buy a 1 year bond. Or buy a 2 year strip. Buy a 2 year strip, and then it will probably at that point, because of its low duration, just be pulled to par on a daily basis. It will have very little movement. It'll be moved around by the 2 year, but in a year it'll be a 1 year, which will reflect the money market rate. So I would not buy beyond your investment horizon, because now you have price risk. Thoughts on manager research as a place to be for someone in their mid-20s? Mentioned buy side is the place to be. Does that also apply to manager research? Only to PE and hedge funds? Well, no, manager research, I guess, is a good place to be. You're just assessing manager performance, and so it's a lot of attribution. It's not the same as stock analysis. I don't know that prepares you for asset management. It may prepare you for sponsor level asset management in the sense of at the strategic asset allocation level, but certainly not in the asset management the micro asset management. Yeah. Sometimes I see put call parity for a particular security seems off balance, meaning that either the calls are relatively more expensive than the puts or vice versa. I want to utilize these temporary disparities when I want to gain exposure to said security. For example, puts are relatively expensive compared to calls. Perhaps a synthetic long is more optimal than buying the underlying itself. Any insight on how to use these put call parity disparities? Well, I don't know how you're calculating the put call. You're saying you're finding this, but I'm taking your word for it that you know what you're doing, that you're doing it exactly right. So I don't know that that's true. So it's hard for me to comment on this. I would say that if you're finding a lot of this stuff, you're doing something wrong. You're missing something along the way. Yeah. So you got to be looking at the same strike price. So it's not going to be a difference in the implied volatility. It's not going to be a difference in the risk-free rate because it's the same. It has to be the same days to expiration. It has to be the same strike price. It depends. I guess it would be. Yeah. Without seeing what you're doing, I cannot comment on this. You could just be doing it wrong. I don't know how you're doing it, so I can't go any further on that. Would it be possible for you to add a feature to your QBank where you can filter flagged questions depending on which topic it is? At the moment, I have a couple hundred flagged questions, but I want to be able to see the ones on the topic I'm revising. I don't know much about this anymore. I don't do any work on the QBank. There are other people who are involved in the QBank now. I would say that this is something you would use support at markmeldrum.com and send your suggestion in and see where it goes from there. I'm not involved in that anymore, which I'm more than happy about. Writing questions is super time consuming and you got to do deep dives. It's not an easy thing to do and burns you out. I mean, you can write questions for 3-4 months and then you simply just get burnt out. They all start to sound the same, look the same, feel the same after a while. And you end up making, like obvious mistakes that you shouldn't be making just because you've just been doing it too long. So I don't really do questions anymore. Perfect duration for the market outlook. Well, yeah, I think so. It's shorter. It's to the point. It's less narration. I like to come up with something new every week. Something to make you think, or if it interests you, then you could pursue more of it on your own. But it does take a huge amount of time, and I do have a looming problem in that the level 3 content for 2025 is almost all brand new, and that lands on my desk sometime mid-February. I don't have the time. I won't have the time for 1 hour, 1.5 hour videos every Sunday. I'll have the time for maybe 20 to 30 minute videos, and that's it. So, and even that might be questionable because it's going to be a long run to get it all up. So, you mentioned the following. You follow big cover ratio during Treasury auction, see whether demand for sovereign bonds remains healthy. Joseph Wang has said in a recent interview that it doesn't put much weight on the bid to cover ratio. He says that in order to be a primary dealer and to be invited to the auction, these institutions got a promise that the auction won't fail, so they're encouraged to place their bids, even if they intend to sell the bonds right away through the secondary market, which they do. I mean, that is what they do. They're dealers. He says the bidding is done more because of policy, politics, regulation than true purchase intent. Not the offer demand. Well, that's not entirely. It's not entirely correct. You have to put in a bid. That does not mean you have to put in an aggressive bid. It just means you have to put in a bid, and that's it. So it's not just the bid to cover; it's the bid to cover combined with the yield that it clears at. And the bid to cover does matter. So I'm not too certain that I would just ignore it. And that the offer demand at the secondary market is the only true metric to really gauge whether there's healthy demand for treasuries out there or not. Well, yeah, that's true. It's the same as car dealerships. Well, they need inventory, so they got to buy it from the auto manufacturers, and then they have to sell it into the marketplace. Well, car dealerships, because of the franchise agreement they have to buy a certain amount of quantity anyways. So you can say, well, the demand from car dealerships doesn't really matter because they're bound by their franchise agreement, and most franchise agreements, not just in car dealerships, but in a lot of places, usually have some minimum performance that you have to meet, so you got to be buying it anyways. So, there is some truth in saying you can't look at the dealer, you got to look at the relationship between the dealer and the eventual buyer. Is inventory building on dealer books? And if inventory is building, it's the same as saying, look, inventory of EV, of Ford F-150 EVs is building on dealership lots. They're not moving. That still doesn't change the fact that those dealerships got to buy it anyways, right? It just means that they're going to have to get aggressive on clearing them off their lot. But which is why the yield is important. Well, okay, I can live with that. That he's saying that he's not that interested in the bid to cover. I guess he's more interested in the yield. Yeah, I don't know that I would argue with him on that. About XLE over the last months and confident on thesis for next year, so our historical drawdown was bad. Yeah, how to manage the emotions, behavior, recession arise, and prices fall sharply. Well, they will. I mean, I don't know that you need to get emotional about that. They will. So have a number at which you say, beyond this, I'm out, and there is your trailing stop. There's where you would want to be stopped out of the market at that number, and just leave. Make it emotionless. Have a limit, a stop limit of, if you say, well, anything under a certain price and I'm out, well, then put that price in. But there probably will be a drawdown at some point. I don't know how long lived it'll be. How do you approach the asset? If recession or price fall softly as we are heading into 2024, how do you approach the assets, banks, market and capital market assumptions report? Well, I don't know which ones you're referring to, so I don't know how to answer that. Deep diving companies in my sector of choice, but don't have an established consistent process. How much research would be too much before making an initial thesis and acting on it? At times I might be jumping the gun without sufficient research. Other times I'm super hesitant and dive way too deep when the added research may have low incremental benefit. How do you approach your bottom up before dissecting the 10K? I don't really do a lot of fundamental research on a company. 10 years of data and looking at trajectories of their cost of goods sold and this cost versus that margin versus this over whatever period of time. I don't really get involved in that. I don't find that would give me any kind of real advantage for the amount of time that I have to do it. What I do is mostly thematic, top-down thematic. So copper is a big theme. Semiconductors are going to be huge over the next 10 years, but that doesn't mean design firms are going to be the winners. It would be, you want to find the companies that are selling picks and shovels to all the gold miners, right? So semiconductor is the industry's big, but when we hear about semiconductors, we're drawn to the Intels, AMDs, Nvidias, but that may not necessarily be the winners, some of the equipment makers, ASML, for example, might be in a better position, especially if you think that a lot of activity is going to happen at the 5 nanometer or lower. ASML is the only company that builds machines, the lithography machines for that. They've got a pure monopoly on that. That's what you want to find. You want to find these choke points. And I think, that's a big theme, right? You have EVs, which require a hell of a lot more chips. You have a desire for more autonomous vehicles, requires a hell of a lot more chips. You have AI. Well, AI needs data, which means you need devices that listen, devices that sense, devices that are always on, devices that are always connected. Well, all of that requires even more and more and more chips. So, the ecosystem, the semiconductor ecosystem is interesting to look at, and you want to find where these choke points are, where there's only one or two key suppliers of something. Like for example, for fabs, there's really only two, Samsung and Taiwan Semiconductor, TSMC. That's really it. Unless we get something big out of the Chips and Science Act out of the US. That's really it. So it's big thematic plays like that. Energy is just a big thematic play, especially for the American companies that are in the shale plays. Free cash flows are huge. Home building is going to be elevated for a while. So copper, home building, something in the semiconductor space in either fabs or the equipment makers. These are big themes, and that's what I look for. And then from there, pick the biggest companies, number one or number two in the sector. Pick the biggest ones because usually there's economies of scale involved, and they're usually going to be in the best position to generate the most cash flow and be the winners. But deep dives on the 10K, I read it because I want to know what they're doing, and I want to understand the company. But I don't know that I'm going to uncover some little line item somewhere where I go, aha, I've got it. This is it right here because of this. I don't know that I'll find that. How did your short LE position evolve once you closed HE and sold short LE puts? Took a small loss on it. It dropped to, I think, 185, and I had 184 puts, and I thought, good enough. Look, I'm leaving the country. I got to move all into fixed income, all into bonds to move them out of the across the border. So those things don't move. Those contracts don't move, and I thought, well, why bother at this point? Let's just take it. Watching since exiting the pairs trade, and have noticed that the WASD forecasts are often quite off for red meat, and spreads usually end up being narrower than forecast. Still surprised things haven't regressed towards the 5-year historical mean spread. I think at this point you have to go beyond the December contract now and go more into the spring contracts and see what the spreads there are. Thanks for the great outlook as always. You might have mentioned this before. What is your source of OAS? You can get that right from Fred. Last week. If I sell a put on Friday with a theta of negative 0.025, does the option value decay that amount each day, even on the weekend? Yes, it does. So over the course of a weekend, total decay is, usually Friday around 1 or 2 is where most of the theta comes out. It comes out ahead of the weekend, so the option drops in price that day by that much. You'll get that theta usually on Friday afternoons, going into weekends. So no, the market will price it in on the Friday so that on Monday it opens pretty, it'll open where the underlying strike price or where the underlying price happens to open. That's where the option will open, but for the most part the theta will come out Friday afternoon. At equal rate and duration, What is most beneficial for investor? Paying off debt or investing in bonds? I have a 30-year mortgage, 5.5. An option of buying 30-year bond at 5.5. Where should my money go? At which point investing becomes more interesting than reducing debt? Well, I mean, they're both 5.5. I would put it, I guess I'd put it on the mortgage. It's such a hard question to answer. You think it's such a simple question, but I got like a ton of follow-on questions. Are you in a region, you're clearly in a region where your interest rate is tax deductible. I think you still have the interest rate tax deductibility on mortgages for your personal income. What's your personal income level? And when you say that you can buy the 30-year bond at 5.5, maturing in 2053, what is the coupon on that, and what would be your after-tax yield? So there's the after-tax position of that as well. Number two is, well, what is your anticipation for changes in rates? If you anticipate that rates are going to drop, you've got to then decide, well, what's going to increase more in value, the home value or the bond, to get that done. So it's which asset do you want to hold over that period of time? There are more questions than just looking at 5.5% and saying, oh, well, they're the same. There's so much more that I'd have to ask on that. But given 5.5 and 5.5, I guess if I find the mortgage payment manageable, then I'd probably buy the bond, and then I would wait for interest rates to drop and then refinance my mortgage at a lower rate. If I refinance my mortgage at a lower rate, I'm still holding on to a bond with a 5.5% yield. Do you get that? So, you could do that. If there is a deadline where access to material, interested in purchasing applied level, deadline where access to material is rescinded? No, there is no deadline to when it's rescinded. There will be a point where I'm done. There will be a point where there'll be no new content, where I get to the point where I say, well, here you go. I mean, here we are. But no, not rescinded. TLT plummeted on Thursday because of the Treasury. Yeah, the 30-year didn't go well. 30-year bonds auction at a yield close to 5. The yield on existing ones 4.7. If that's the case, what could explain significantly higher yield at auction? I don't think the market cares what's going on in Palestine. I mean, the bonds today sold right off, and you had a summit in Jordan canceled. You had Biden showing up in Israel saying the same thing. Israel has a right to defend itself. And you had Biden agreeing that, Israel didn't bomb the hospital. It was something else. So this really just gives Israel more permission to continue doing what they're doing. Now, let me say something here about this right to defend yourself. I agree. You have a right to defend yourself. If you were standing in front of me, wailing away punches at me, I have a right to defend myself. But I do not have a right to go around you and beat the bloody shit out of your children. I have a right to defend myself. That means against you, against the aggressor. Not against your children, your parents, your neighbors, and then burn down your neighbor's house. I don't have a right to do that just because you're throwing punches at me. I got a right to defend myself. There is a fine line between defending myself and seeking revenge. Israel has a right to defend itself. It does not have a right to seek revenge. And that's what's going on. The Palestinian population, for the most part, are not the aggressors here. They've been victims for a very long time, and they don't deserve what's happening to them. I think we should be able to separate those two things. I think we should be able to say, you are no longer defending yourself, you're seeking revenge. And number two, it's okay to support the Palestinian people without without it meaning you're supporting the worst elements of Palestine. Right? It's okay to say I support black communities without it meaning I support black gang violence. I think we get that. It's the same thing. So it is okay to say, look, what's going on is wrong. And what is going on right now is gone way beyond defending yourself. So with that going on today, yields still dropped. We were back to this curious situation of the U.S. dollar getting stronger because it's a safe haven currency, but equities and bonds selling off. Where the hell is the money going? Like, where's it going? Now, mind you, oil was up considerably, and if oil is up considerably and the U.S. dollar is up considerably, you have countries that have to import oil in U.S. dollars. They're going to have to get those U.S. dollars from somewhere, which means maybe they're the ones selling assets to buy an ever-increasing U.S. dollar because they need that U.S. dollar to buy an ever-increasing oil price. That seems to fit the stronger U.S. dollar, weaker equities, weaker bond scenario. But one of those three things is wrong. If it's not an operational issue, like I just described, then one of those three things is wrong. Either the currency should be weaker because money's flowing out, selling equity, selling bonds, some of that money would be flowing out of the country, or equity should be rallying, or bonds should be rallying. One of them is wrong. I don't know which one. I don't understand what is going on with yields right now and why people are not jumping all over them. Again, let me just describe the 25-year strip. The 25-year strip is around 28%. That means you'll pay $280 for a $1,000 face value, and it's got 0% interest. It's a strip. So you basically have a duration of 25 on this thing. If the 30-year, not the 30-year, but the 25 gets back to a 3% yield, if you go back to a 3% yield, it's a 2.6 times return on the 280. Why that's not being jumped on all day long by pension funds, banks, not mutual funds, but life insurance companies who have been praying for this for years. I don't know. I mean, I don't get it, but I am more than willing to buy. I am more than willing to buy. You know, I've never really been much of a bond investor, and I asked myself the other day, I said, if I wasn't leaving the country, would I be this aggressive on buying bonds? And I thought it through, and I thought, well, yes, I would. In fact, I'd be more aggressive. I'd be way more aggressive in buying bonds. I wouldn't have bought anything with a coupon. I would have bought more. And I'd probably be all in zero coupon bonds right now, just sitting back with a big fat cigar and laughing, just waiting for the Brinks truck to pull up to my house because mathematically that Brinks truck is coming. Mathematically, it's coming. Let's see. So much of the market outlook and markets in general is based on interest rates. That's the cost of money. That is the price of money. So yes, almost everything is based on the price of money unless you got a good story. Unless you can come up with a really good story, then you don't have to worry about the price of money. These numbers wield more influence on the world than many politicians. Well, yeah. Profound impact of these figures and the individuals who calculate and publish them. No, there are no individuals who calculate and publish them. These are yields that are the result of market forces, supply and demand for certain types of bonds set up what the yield curve is. How can we determine their accuracy and reliability? They're accurate and reliable. Well, I mean, they're as accurate and reliable as the market determines that is the price of money that day. What's the exact procedure for publishing each number? Should we accept these numbers as the foundational truths from which we deduce market behaviors? Well, I mean, I would accept the numbers as truth. They're the numbers are fact. It's not a calculation where 10 analysts will come up with wildly different numbers about what a fair price is. it is what it is. Yeah, so, yeah. The importance of reading philosophy books. Do you have a specific book recommendations for a novice in philosophy? Someone typically not used to the typical philosophical writing style. Yeah, it can be inaccessible. Some authors are just brutally difficult to read. You read them and you say, what the hell are you talking about, man? So you first of all have to sort of understand how philosophy is written and what it's writing about. It's not psychology. Like, you can read psychology and say, okay, well, like social psychology sounds like philosophy in a sense. It's the behavior of crowds. But philosophy talks a little bit differently. I would find myself a first-year introduction to philosophy textbook, which goes through the major schools, and maybe the major philosophers, maybe the top 20, 30 of them, and, from Plato, Aristotle, Socrates through to more modern times. I'd find myself something like that. And then, some of the schools of thought are more accessible than others. Some wrote by analogy only. So you have to sort of try to figure out what they're saying. And it does take time. But the more you read, the more you get to know it. And it's okay to rely on different published professors of philosophy who will break down an author for you, break down a philosopher for you. But I'd probably start with an introduction to philosophy, and you'll cover, I don't know, 20, 30 philosophers briefly. The big highlights of their career, and then you can determine, where you want to go from there. If only able to make broad market moves, would it be better to buy XLR versus SPY if rate hike cycle is expected to be done? I don't know. I don't know, because I'm 50-50 on where we are in the markets, and I've never had more uncertainty than now, which kind of makes bonds a nice place to be. I can't answer that. I just don't know. If I understood correctly, last Q&A you said you don't really set a target price for stocks, and said you look at how they are positioned to succeed and possible catalysts. Yep. If so, does this mean you're not attempting to exploit a market, exploit a price and intrinsic value? No, I just want to know that something is going in a certain direction, that a certain market is going to be attractive, and there's some companies that are well positioned to take advantage of it. That's all I need to know. But the target price is notoriously random. Let's just say that it's notoriously random to do that. For example, if we look at Tesla, I did a video about 2 years back where I said, end of 2023, 2024, 2025, here's where its gross margins are going to be. I've been bloody spot on those, and it just had earnings tonight, and its gross margins dropped again. In fact, it's dropping faster than I thought that they would. And I had forecasts for sales, and I've been right on that. I didn't give them 50% sales. I gave them much lower than 50%. I've been right on that, but not on the price, because my thinking was that in time, the fundamentals would come into the price. The market would realize this is a car company and price it as a car company. But Tesla packages hope with every delivery. Full self-driving is just around the corner. The truck is about to ship any day now. You just watch. I'm telling you, it's going to ship any day now. Full self-driving is right around the corner. The truck's been going on for 4 or 5 years. So full self-driving, he's been promising that for almost 10 years. But that hope, the shareholder base buys into that hope. That sort of just disappeared on the earnings call tonight. Little iffy on Mexico. Blaming high interest rates, not too sure about Mexico. Growth rates aren't there, missed on revenue, missed on EPS, missed on margins, basically missed on a lot. China's looking like it's falling apart. So I've been right on the fundamentals on if you think about the industry that you're in, you cannot escape the gravity of the industry that you're in. You can't. Every industry is a black hole and will suck every company in by its industry structure. You cannot escape the industry structure. But the price, I have not been right on the price. At the end of last year, I was right on the price, but I'm not right on the price now. So price targets are just notoriously difficult. So I find that it's enough for me to say, oh, this price is going up. Good enough. I'm good enough with that. Do you think that the dividend investing for a retail portfolio is really better than just broad global equity index? Dividend investing for retail retiree portfolio is really better than just broad global equity index. Why are they different? Why do you think those two things are different? Do you mean in the sense of having a portfolio that is weighted more towards dividend payers as opposed to just having a broad market index like the S&P or the MSCI All Country World Index? Well, for retirees, you need some kind of income. I find that the dividend payers give you that income, and they tend to hold their price. They tend to have a lower beta and lower volatility because they do have a yield. I don't know if it's better. I'd have to ask a whole bunch more questions about your situation to be able to answer that, but I don't know if it's better. Just on the face of it, nothing is better. Context is everything, right? Is it better to eat an apple or is it better to eat a chocolate bar? Well, I don't know. Do you have low blood sugar and are you lightheaded because your blood sugar is low and you're about to seizure? Then bloody well have a chocolate bar. That apple's not going to be any good for you. See the difference? Right? Give me some context. But which one is better? I don't know. Tell me a hell of a lot more, and then I can give some assessment about the pros and cons of each one. I know leverage ETFs are risky. Is now not the perfect time to begin a position in the direction 3? I'm gonna pass on that. No, I mean, is now not the perfect time? There is no perfect time. You can't time the market. You cannot time the market. What if yields go another 100 basis points on a 3x? You'll be wiped out. You'll be slaughtered. So no, I don't think it's ever a perfect time unless you can tell me that you have an incredible track record of timing the market, which you don't. Then no. Dr. Mark Mellon of Geopolitics. Peter Zeihan. I think his data is really good, although his conclusions are almost fatalistic. Like they're pretty wild conclusions he draws. But his data is good. Are you worried about your TLT trade at all? Nope. What will change your view on this trade and give it up? Nothing. If we do have a structural change on inflation, Fed has to stay higher for longer and do not cut rates in foreseeable future, then there will be a massive wealth transfer from companies to bondholders, and there'll be a massive wealth transfer from taxpayers to bondholders. That's where the wealth transfer will happen, and there will be an underinvestment from companies because of the high cost of capital. Which means that returns are simply just going to be lower. They're just going to be lower. Margins are going to be lower. So in a higher for longer interest rate environment, if you go back and look at what margins were, they were more around the 6% range. Corporate margins jumped to 11-12% after the great financial crisis as interest rates dropped to 0%. So nothing would make me change my mind. It's economics. It is, again, the gravity of economics. You cannot escape that. No company can escape it. It's like a black hole. It will suck you down into it. Nothing will make me change my mind. I don't know that you have a structural change on inflation. I doubt that. I really doubt that. Here is why. In the 70s, your money wasn't going to China. Your money wasn't going to Russia. Your money wasn't going to Eastern Europe. Your money wasn't really going to South America either. Your money wasn't going to Mexico. You were pretty much trapped in Western Europe or North America. So your money really wasn't going anywhere at that time. So you had to, and technology really wasn't what it is today. So you didn't have the world that you had today. Well, today, money can go anywhere. Supply comes from anywhere. You have a level of technology that is deflationary. All technology is deflationary. All of it is. So we have a growing backdrop that's deflationary. So no, I don't buy in to the we're in a new phase of higher rates now, that the great moderation is over. No, the great moderation isn't over. The great moderation really started happening, I'd probably say in full force, probably mid to late 90s. The great moderation really took off. Well, what was the big thing that happened there was the internet. The cost of communication and the speed of communication. The cost of communication dropped and the speed of communication increased, and you had a new infrastructure called the internet, which facilitated a whole bunch of cost savings for companies that weren't imaginable before, and the ability to scale that was never imaginable before. So no, this is not the 70s. This is not the 80s. This is not even the 90s. We live in a brutally competitive world where the pace of innovation is brutal. Interest rates at these levels, I don't think can hold if inflation is not your enemy, which I don't think it's going to be. Yeah, oh yes, you'll have energy issues and you'll have food issues, but the core, I don't think so. Paradoxically, you could solve housing inflation if you dropped interest rates to zero, because you would get a flood of supply onto the market. So I don't buy in to this whole notion that, oh, the low rates, those low rates are gone. No. Look at Japan. Look at Japan for the last 30 years. And I think that is the fate of all advanced developed economies, is the capital deepening. And I'll draw this out here. Many of you from level 2 will remember this, that as you have labor, a bunch of labor, and you add capital, you can get growth, but then that tapers off. So that if you add more capital, this is your output per labor, this is your capital per labor. As you add more capital, it doesn't increase growth. You have to continue to rely on technological advancement to increase your growth rate. Well, this technological advancement is deflationary by its very nature. So this is where advanced economies are now in boosting their growth rates. It's done through A, right? Y equals AFKL. That is the total factor productivity. It's done through that. So we are living in a backdrop, I think, of deflationary pressures. So no, I just don't agree with this. I don't think we have a structural change on inflation. I don't think they can stay higher for longer. When these last couple of years, the crowd has been wrong, including me. Long-standing relationships just haven't worked out, and even today, there's a credit investor on Bloomberg saying we have no idea what's going on with credit spreads and why they're so tight. How come credit is so expensive right now? We have no clue why. No clue. And they've been doing this for years and years. Billions under management, and they have no clue what's going on. So when everybody's saying, oh, this is going to be the new normal, first of all, you're wrong, I think, because no one really has consistently gotten these past few years right. All the collective wisdom of years of investing and years of skill meant nothing, because markets just did what they did, and everyone was standing around scratching their head going, what the hell is going on? Much like I'm doing now. Stronger US dollar, weaker equities, weaker bonds. What the hell is going on? Where's the money going? It's a puzzle. But in time, the forces of economics will win. The gravity of economics will win. View on copper and FCX, over what time period? How does the rate rising on the long end impact equities? Well, do you want the textbook answer, or do you want the real world answer? Real world? I don't know. Some days it has an effect. Other days the market doesn't give a shit. So it's like, whatever's going on. If there's something else going on, then who cares about interest rates? If there's nothing going on, well, I guess we'll care about interest rates. View on copper and FCX, I got to have a time frame for that. If you're asking me how they're going to do tomorrow morning when they report, I don't know. Beats me. From quarter to quarter, there's so many wild cards in there you don't know. But over the next 4 or 5 years, yeah, I'm constructive on where they can go. Enterprise value being the market value of operations of a firm. Therefore, the value of operating assets. Doesn't that mean a change in? I don't like it already. Doesn't that mean a change in operating working capital? Another change in working capital? I don't even know where this question is coming from, and I got some problems with the question setup right away. I guess the thing that I would say is, you give me a change in working capital that is not operating working capital by its very definition of being working capital. You give me something, and then we can talk about that. But yeah, I don't like the setup of the whole question. Some time ago, you did a video on an article author, and you started with a poem, something about choosing a path. That is the path not taken. The path not taken. If you had about $1 million of retirement saved and had to draw $7,500 a month, so $90,000 a year, or 9% for the next 15 years, how would you allocate the money? Well, first of all, you've got to lower your expectations here. 90,000 for 15 years. Well, I guess that could be done. It's just you're going to run out of money. I mean, you're basically going to run out of money in 15 years if you're doing that. But I mean, if you took 5%, bought 15-year bonds with a very high coupon, you could probably get by on the coupon and selling just some of the bonds each year, but you're gonna run out of money. I guess that's the plan, right? Is to run out of money. But you could do that. 90,000 for 15 years is 1,350,000. You're at $1 million. So over 15 years, you only need a collective 35% return, which is what, 3% return a year. But you will run out of money. Has anyone looked at the historical accuracy of forward earnings estimates? I don't think it would matter what the accuracy was. It wouldn't matter. It is a way of pricing the market based on a consensus. We think the consensus estimate is this, and as companies start reporting earnings, you then adjust that number versus the consensus. If it's coming in higher, it justifies a higher price on the market. In an efficient market, we're assuming the market's efficient and always in equilibrium, then yeah, it would justify a higher priced market. If it came in lower, it would justify a lower priced market. It just gives you an idea that if the market was priced in equilibrium based on what consensus was, then you could determine relatively, as earnings are coming in, whether the market should be going up or down. But the whole idea is the market priced in an equilibrium mode based on the earnings forecast. That would assume there's no behavioral bias in the market, and it is priced. The pricing model is correct. It's not, and it's not on both those counts. So it's, again, how is the market going to respond? Well, does the consensus think the market was priced for perfection and that earnings should have come in much more? Did it price the multiple out because that was the expectation? Did it meet the expectation but the guidance sucked? I mean, there's so much more than just that, but I don't think the accuracy of it even matters. Howard Marks' investment philosophy and view influence your investment approach to any extent. He's big on cycles. If you're doing any kind of economics, you're going to bump into cycles. His case against forecasting conditions. Would you say your approach to market outlook goes against Marks and Buffett's approach? I don't know if they go against the approach, as opposed to using something they wouldn't use, but I don't think it goes against what they do or against how they do things. The idea that they don't consider the current macroeconomic environment and have some idea of what they think is going to happen, I doubt that. I really doubt that. I'm sure both of them consider the macroeconomic backdrop. I'm sure they do. To ignore it would be foolish. To attribute or attempt to attribute a lot of precision to it would also be foolish. So the peso. Are you not interested in any particular sector exposure in Mexico? Not really. Are you generally not interested in equity exposure in that market? Not really. Or the big winners multinationals moving labor expenses to Mexico? It wouldn't matter what's going on. It's a macro play on the peso. I don't know if companies, if there are good companies in Mexico that can manage their money well and manage their margins well. But a currency has no management team, has no accounting scandals, has no cost overruns, has none of that. It's easier to sort of say, well, money's going to flow into Mexico. Good enough. There's my first trade. Money's going to flow into Mexico. There's my first trade. I don't know if it's going to be profitable, but money's going to flow in. Isn't inflation rate bound to cool down automatically? Well, not automatically, but to cool down under the weight of continual innovation and progression, yes. If a price level is 100, then goes up by 10, then the rate will be 10%. Oh, I see. If it just keeps going up by 10, 10, 10, 10, 10. Well, yeah, you're making an assumption on that, but it's if it's going up by 10 each time, well, if it's going up by 10, it just means inflation is down. It doesn't mean that mathematically inflation will be down. It means that inflation is down, so mathematically it only went up by 10. You're just doing it the wrong way. You're looking at the price increase, the price level increase, and assuming mathematically that the calculation of inflation is lower. That's not how it works. It's that the price increases have been lower, the measure of inflation has been lower, which then resulted in only 10, an increase of 10. So much risk accumulating in Israel. Why is TLT still falling? You got me. That one I do not know. What would be your strategy? Splunk was bought by Cisco. You own 100 shares at 145. I sold a call that expires in October at the 140 strike. It's currently trading at 146. Cisco purchased Splunk for 157. Fall of 24. What should I do with my call? Should I let it expire and I sell my shares at 140? Yep. Keep rolling it forward. Well, there'll be nothing in the option. There'll be nothing to roll it forward for. No one will take the other side of that. There'd be no point. There is no additional premium to collect. They will simply be priced to the point where you're not going to make anything on it. They'll be priced at their intrinsic value, period, and that's it. Someone who's recommended Mark's courses on CFA for a while to everyone, something has happened, the quality fell off a cliff. No answers in the comment section. Yeah, I mean, I brought that up many times. My ask the instructor questions go ignored. Well, I mean, how many questions are you asking, right? I mean, if you're asking 100 questions a week, if you're one of those that are asking question after question after question, yeah, it's going ignored. Yeah, it's going ignored. All videos are years out of date. That's a lie. That's not true at all. And not updating to modern CFA content. I don't know what you mean by modern, but that's a lie. Every video matches the content. If it's 2023 content, the videos match the 2023 reading. If it's 2024, the videos match the 2024 content. You can have a reading that hasn't changed for 4 years. Well, you know, what's the point of narrating the same thing every single year? If it hasn't changed for 4 years, it's the same thing. So if you're looking at copyright on something on one of the videos and see 2020, it simply means that that reading has not changed since 2020. But years out of date, that's a lie. That's not true. I'll have to try a different course level. Well, yeah. If you are one of those people who are asking 200 and 300 questions, we do encourage you to look elsewhere because you are hugely expensive to carry. For the price that we charge, we simply can't be your personal tutor on call. So, you know, I'd have to ask a whole bunch more questions of how many questions are you asking? What types of questions are you asking? There are some questions which you could simply just look up. About 60-70% of all questions asked are questions that you could just look it up. You know, so very disappointing, but the quality is gone entirely. I don't think so. You know, I know that that's a lie. All videos are years out of date. I think you're just trying to be hurtful because you feel that your questions aren't being answered. But then again, it's a matter of, well, how many questions are you asking? I mean, if you're, you know, pulling up a chair to the buffet table, then yeah, we're cutting you off, right? What are your thoughts on Pierre Poilievre, leader of the Conservatives in Canada? There's a video going viral with him coolly answering a critical journal while eating an apple. Yeah, I saw that one. The journalist is not a very good journalist. Said you're appealing to a populist thing. He says, what does that mean? He couldn't, and the journalist just couldn't answer. He says, no, well, give me an example. What do you mean? Give me an example. Journalist couldn't do anything. He said, well, you're taking a page out of Trump's playbook. He says, what page? Give me an example. Tell me. What are you talking about? Journalist couldn't answer it. And I thought, yeah, you know, like, I wouldn't have stopped. So kudos to him for stopping. But I would have gone on the attack. I would have gone on the attack the moment I sensed weakness in him. The moment I sensed he was unprepared, I would have ripped him apart. I would have just bloody ripped him apart. But kudos to him for pulling back. But I guess it was the journalist who had to eventually post it. So I would have had to think if I ripped the journalist apart, no one would ever see it. But yeah, I did see it. It's pretty good. I think he's well spoken. I think he has something in the common sense approach, because we are lacking a lot of freaking common sense these days. Like just ridiculous stuff that we're funding. You know, I think his defunding the CBC makes sense. Why should taxpayers pay $1 billion to a liberal station that really goes out of its way to insult 66% of Canada? I mean, why should we? And if nobody's watching it, then why should we continually? So, you know, I agree with him. I agree. But, Trudeau funds the CBC by $1 billion, so the CBC gives him glowing coverage. And if there's bad stuff on him, they bury it. Oh, they'll mention it to show that they're being unbiased, but then that's the end of it. If a Conservative member of Parliament jaywalked, they would cover it for a week. There'd be panel discussions about the guy's character, his morality. This person has to go. Yet Trudeau, 3 times in his past, wore blackface, and they covered one little part on a plane where he apologized, saying, "You know me, I like to wear costumes. Haha, sorry about that if it hurt anyone." And that was it. No panel discussions, no nothing anymore. That's what taxpayers are funding. So I agree with that. Common sense may be coming to Canada. Don't say it out loud. You'll jinx the whole bloody thing. And you know what? I'm leaving Canada. Anyway, so there's a part of me that hopes common sense doesn't come back and a whole bunch of people like me with capital simply just leave Canada. Would you please develop your thesis on agency? Why such a screaming buy? What spread are you exactly talking about? Well, I would recommend that you watch the video I did for agency in the applied series. I guess that's what I would recommend, or at least read their 10K to determine what their business model is and exactly how they make money. But it's the spread. You have to look at the spread. This is agency. This is a security you're buying where you have a de facto government guarantee. You cannot lose on this thing. And at some point, rates are coming down. So that's the beautiful, and with the spread the widest, super wide. How much wider can it go when it's backed by something? Who cares? Who cares if it's backed by housing? Who the hell cares if it's backed by somebody who has to pay a mortgage? The point is, it's got a de facto government guarantee. So even if the mortgage holder defaults, it doesn't affect you. And that's why it's such a screaming buy. Generac reports on November 2nd. I believe the document you're using is also wrong. There's something funny about the earnings report, the earnings calendars. S&P is, or SP Global, not S&P. SP Global is hit and miss these last few weeks. Sorry, Howard, if you're listening, but you kind of hit and miss. About the last month, you've been hit and miss. This month when they say these companies are reporting, it's like, well, sometimes they do, sometimes they don't. But yeah, I think it's all messed up right now. And that'll take us to the end of this.